Okay. Hello everybody, welcome to this week's BizSmart Lunch and Learn webinar. We will be running a series of weekly webinars aimed to provide advice and share knowledge on key business topics in specialist areas such as employee pensions, social media training and finance. So why not block it in your diary as a recurring event and join us every week. You will receive feedback questionnaire after the webinar, so please can you fill it in and give us any suggested topics for the future. Today I would like to introduce Ian Priest from Independent Banking Consultants, a member of BizSmart Select and advisor, and an expert in helping businesses raise finance and support them with other lending related matters. Please take the opportunity throughout the webinar to ask us any questions using the question function on your panel, and we would answer as many as we can at the end of the session. Well, thank you. Over to you, Ian.
Okay, so good afternoon. My name's Ian Priest. I'm from Independent Banking Consultants, and I've been a select member and a growth advisor pretty much since the start of BizSmart. Okay, so today's presentation is on invoice finance and why invoice finance gives an illusion of simplicity. Invoice finance actually is quite a complicated lending product, much more so than many people realise. I want to try and demonstrate that by looking at some of the key components of invoice finance and how it works. Before we do that, briefly give you a quick overview about Independent Banking Consultants. We arrange finance for businesses. We provide ongoing support for borrowers with their facility renewal, advice on their banking arrangements and the relationships, and we help non-borrowers manage their banking. We also support borrowers when they get into difficulties with their bank and the bank's no longer being friendly. So what's invoice finance? In essence, it is actually very simple. You sell your invoices. So instead of waiting for whatever your credit terms are, be that 30, 60 or 90 days, you can have the cash now, today, in your bank account straight away. What could be simpler? Well, quite a lot of things actually. Before we go much further up that, let's just have a quick look from the other side of the fence at why lenders prefer invoice finance. When a bank lends money, they have to put aside an amount of their own cash to cover the risk of default. This is called capital. Capital is a scarce resource, and overdrafts, which are the ideal way to fund your working capital, are a very inefficient way for banks to use their capital. If you've got a £100,000 overdraft facility and you're not using it, the bank has still got the capital for that £100,000 put to one side. Whereas if you've got a loan for £100,000, the capital's being fully used. So overdrafts from a bank's point of view are very inefficient. There's another very good reason why banks like invoice finance. They make a lot more money out of it. So why is it not a simple product? And the bank salesman turns up and says, what could be simpler? You raise your invoice for £1,000 and I'll give you £850 today. You can have the other 150 when the invoice is paid. But there are so many moving parts and lots of ways for invoice finance to trip up the unwary. And hopefully over the next few minutes we'll guide you through some of that. I'm talking generically about invoice finance, but it has lots of different names. Confidential invoice discounting, chocks, full service factoring, even single invoice. They all do essentially the same thing but have different processes behind them. With confidential invoice discounting, the idea is that it is exactly what it says, confidential. You do all your own bookkeeping, you do your own invoice chasing. In theory, your customer doesn't know that you're using invoice financing. Chocks is client handles own collection system, which is similar to confidential invoice discounting, except it is disclosed. So you still do all the credit control, but it does say on your invoices that payment needs to be made to the finance company. Full service factoring is going another step further, where the finance company do all the chasing of the invoices for you. So once you put it onto the system, effectively they go out and collect the money, and you are not involved in it. And single invoice is just, again, what it says on discount, a single invoice. Obviously the sorry, we've got a problem.
Yeah, hang on, sorry.
Just bear with us for
The
a
broadcast
second.
is now starting. All attendees are in listen-only mode.
Going back to the beginning now.
Please bear with us. Sorry about this. I think we need to start again. If I can just welcome you all to this Lunch and Learn webinar. We are running a series of weekly webinars aimed to provide advice and knowledge on key business topics and specialist areas, such as employee pensions, social media training and finance. So why not block this in your diary as a recurring event and join us every week. You will receive a feedback questionnaire after the webinar, and we would encourage you to make any suggestions for future topics, please. Today I'd like to introduce Ian Priest from Independent Banking Consultants, a member of BizSmart Select, and an expert in helping businesses raise finance and support them with other leading related matters. Please take the opportunity to ask us any questions during the webinar, and we will do our best to answer them at the end. Thank you, Ian. Over to you. Again.
Sorry about the technical gremlins. My name's Ian Priest. I'm from Independent Banking Consultants. I'm a BizSmart Select member and BizSmart Growth Advisor, and have been with BizSmart since the outset. Today I'm talking to you about invoice finance, an illusion of simplicity. Invoice finance is actually a very complicated product. Much more so than many people realise. This presentation seeks to demonstrate this by looking at some of the key components of invoice finance products. Can we change that? Next one. Before I get into the meat of invoice finance, the quick advert. Independent Banking Consultants, what do? We help businesses raise finance. We help businesses keep the finance once they've got it, with their renewals, their relationship with their bank, and we help businesses when they've got into difficulties with their bank and the bank has stopped being friendly. So, what is invoice finance? Put simply, you sell your invoice to a financial institution. So instead of waiting for your normal credit terms, whether that's 30, 60 or even 90 days, you can have the bulk of the cash now, today, in your bank account. So why do lenders prefer invoice finance? There's been a big move over the last few years towards invoice finance and moving away from overdrafts. The reason for this is twofold. When banks lend money, they have to put aside an amount of their own cash to cover the risk of you defaulting. That's their capital. Overdrafts are a very inefficient use of capital. So, for example, if you've got an overdraft facility of £100,000 and you're only borrowing £1,000, they've still put capital aside for £100,000. So there's £99,000 worth of capital not being used. Whereas if you had a loan for £100,000, the whole £100,000 is being used, the capital is being used much more efficiently. The other reason they like invoice finance is it makes a lot more money. That makes a lot more money for the bank. So the bankman comes out to see you and he says, what could be simpler? You raise your invoice for £1,000 and I'll give you £850 straight away. You can have the other £150 less my charges when the invoice is paid. Simple. Really easy. Except it's not. The reality is there are loads of moving parts and lots of ways for invoice finance to trip up the unwary. Now, I've just been talking generically about invoice finance. It comes under a multitude of different names. Confidential invoice discounting, CHOCS, full service factoring, single invoice, essentially they are all the same facility. You're selling your invoices and getting the money quicker. Confidential invoice discounting should be totally confidential. Your customers don't know that you're financing their invoices. You do all your own debt collection and all the management and all the chasing of those invoices. CHOCS, client handles own collections. Very similar to confidential invoice discounting. You do all the bookkeeping, you do all the chasing of the invoices, but it is disclosed to your customers. So on your invoice it will say pay XXX finance company. Full service factoring, that's going another step where the factoring company take full ownership of the invoice and they do the collections. So they will send the reminders out, they'll send the statements out, they'll chase the overdue invoices. And then single invoice, exactly what it says. You can factor a single invoice. So if you've done a particularly large one-off job for a blue chip company and you need the money quickly to fund the next work, you can just factor that invoice. It's more expensive because you're doing just a single one, but it's there, it's a facility that's available. The cost. There are two costs with invoice finance. Actually, there are more than two. The two main costs are the service charge. This is the one that usually takes people by surprise. This is levied on all sales, including VAT, and it's normally expressed as a percentage of your sales. It may be a fixed fee, and it'll be variable depending on the service, the amount of invoices you put through. Normally, there's an annual minimum charge. Every company has a slightly different way of doing it, and this again is some of the moving parts that you need to be aware of. So, for example, you might be turning over £100,000 with a 0.5% service fee, but a minimum charge of £8,000. So, based on the turnover, it should be 5,000, but because there's a minimum, you'd be paying 8. Then there's the discount margin. That's the interest, if you like, that you pay on the funds that you use. It's worked out daily on the balance that's outstanding. Please be very careful. Some lenders quote a margin over base rate, but then it's only in the fine print that you see that their base rate is not Bank of England base rate, and it catches a lot of people out. Also watch out for minimum rates. So they might be saying they've got offering you interest at 2 over base, but their base rate could be 2.5 rather than Bank of England, which is currently 0.5, or they could have a minimum of 4. Whichever way, you're not going to be paying 2 over base. Other costs. Arrangement fees. Yes, very typically they charge an arrangement fee for setting up the facility. Take-on fees. This is the one bank salesmen never tell customers about. When you first start, you've probably got 1, 2 or 3 month invoices already on your ledger that you're going to put onto the system, and you pay the service fee on all those invoices on day 1. So if you load up your entire ledger on day 1, you're going to pay effectively what you were expecting to pay a 3 months service fee because you put 3 months worth of invoices on. Security fees. They're probably going to charge you for taking their security. Different lenders will have different security fees and require different amounts of security. Audit charges. Because a lot of this facility is done on trust that you are loading genuine invoices, they do come out and check. They call it an audit, and a member of the lender's staff will come out and sit in your office and go through your ledgers. Some charge for that, some don't. It can be quite substantial. If they're charging £500 a time and want to come 4 times a year, you're looking at an extra £2,000 in charges, whereas another company may not charge at all. Overpayments. If a lender classes a payment you've requested as an overpayment, in other words, you've exceeded your credit limit or you've exceeded the percentage they'll allow against any one company, they class that as an overpayment and they make an extra charge for it. Refactoring charges. If you've gone an invoice that's gone past its normal 90 days and you want to re-put it through the system, they'll charge again. Annual renewal fees, like the arrangement fee. Some lenders will charge annual fees for maintaining a facility. Same-day payments. Nearly all lenders offer a free transfer to your bank account if it's being done by BACS, which takes 3 days. So you request the money on Monday and it hits your account on Wednesday or Thursday. If you want the money straight away, you can have it, but there's normally a cost. I've seen that range from £3 to £100. Again, it's one of those costs you really have to watch out for. And bank charges. You'll be paying all any checks that come into you or any direct payments that come into you won't be coming into your bank account, they'll be going into the lender's bank account. Some charge you the bank charges for those transactions. Again, some don't. It's a cost to look out for. Right, so key areas to consider and why sometimes the promises don't live up to the reality. The advance rate. They might say to you, we will do 80% of your invoices, or 85%, or 90% even. However, that's the starting point. There can be lots of dilutions, things that will reduce that, particularly if you have lots of credit notes, or you get some clients that are not allowed in the facility if you breach the credit, if they breach their credit limit. There's lots of things that can actually reduce the amount that they will advance. One of the key ones is concentration. Too many of your invoices are to one company, they will put a limit on it and reduce the amount that you can borrow. The facility limit, that's the top limit on what you can borrow. It's like your overdraft limit. And normally if you want that increased or you go over it, they're going to charge an extra fee for that. The recourse period, how long they'll actually fund your invoices for. You need to make sure it fits with your trading terms. Typically, they will fund up to 90 or 120 days. But if you give your clients 90 days credit as standard, 120 days may not be long enough. So you need to make sure that the recourse period fits with your method of trading and that it is actually going to work. Minimum lending term. Normally contracts are for a minimum of 12 months with a notice period afterwards. So if it's a minimum 12 months and 3 months notice, that's a minimum 15 months. I've seen terms range from 1 month minimum to 2 years minimum. And if you come out within that period, there will be break costs. Typically, the minimum service fee for the remaining period and an estimate of what the interest would have been during that period. Notice period I've already mentioned. That's normally on top of the minimum lending term. So as I said, if it's 1 month and then 3 months notice, 1 year and 3 months notice, that's 15 months minimum. Credit limits. This is credit limits on your customers. Normally, if there's a big spread, they'll give every customer up to 10% of your limit. So if your credit limit is £100,000, they're probably not interested much in invoices that total below £10,000. However, for larger clients, you will have to get individual credit limits. If they put a credit limit of £20,000 on a client and you've got £25,000 worth of invoices outstanding, there's £5,000 worth of invoices they're not going to fund against. Credit insurance, cover for bad debts. This can be bought separately. Sometimes it's offered as a bolt-on, but again, you're working to the credit limits. The credit insurance is great because it means if the company doesn't pay, you should get the money back. But again, if you go over the credit limit, they're not going to fund it. Debtor concentration limits. I mentioned this before. If you've got a particular big customer that in any 1 month becomes a large part of your turnover, then there will be a restriction on how much you can borrow. So, for example, you might have a client with a credit limit of £50,000 and you've done £100,000 this month. Well, they could be 50% of your turnover. If the concentration limit is 30%, there's 20% of that invoice that's not going to be funded. Actually, it's 40% of that invoice that's not going to be funded. That can have major impacts on your cash flow. Debt return restriction. This is a weird one. Some lenders look at how often your ledger actually turns over. So if all your customers pay on 90 days, your debt turn is going to be a lot slower than when you've got clients paying you on 30 or 60 days. And again, you need to watch out for any restrictions on that, on how often the debt needs to turn, because it does mean extra charges. And credit notes. If you raise a lot of credit notes, that'll cost you more, but it will also reduce the amount you're able to borrow because they will put a restriction against the facility. And if all those technical areas aren't enough to confuse you, then there's other areas to consider. Directors' guarantees and directors' indemnities. There's a big difference between a guarantee and an indemnity. A guarantee says if the company doesn't pay the money back to the bank or the lender, you will. An indemnity is normally against the fact that you won't raise fictitious invoices. Some lenders ask for guarantees, some ask for indemnities, some ask for both. They're really there to tie you in to make sure if things go wrong, you will stay around and help them collect the invoices as much as possible. Beware for sales tactics. Beware other costs. If the bank says you must go for invoice finance, the first thing you should do is go and look somewhere else, because the bank facility may not be the cheapest. You have to look at all the costs, not just the headlines. So, finally, the key areas to consider: when invoice finance works best and when it won't work at all. Invoice finance works best with a sell it and forget it product. If you make widgets and you deliver 1,000 widgets to 10 companies every month, then invoice finance will work perfectly. If your turnover is growing, it helps to fund the growth. Invoice finance doesn't work if it's a very seasonal business, if you have large concentrations, unless you get a specific agreement to fund the concentration. If sales are declining, invoice finance can be a nightmare. It's brilliant while your sales are growing, but when your sales start to fall off, it can be accelerate a problem, because if you had £10,000 worth of invoices in month 1, but you only get £8,000 worth of invoices in month 2 and £5,000 worth of invoices in month 3, your facility is reducing rapidly each month, and it can accelerate the run out of cash. So there you go, invoice finance. It's very simple, not. Any questions?
Thank you so much, Ian. That was a great session. We do have a question. Will banks finance invoices to consumers as well as other businesses? E.g., if you sell alarms, will you get an invoice financing on private as well as commercial?
There's a very simple answer to that one. No. They will only finance business-to-business invoices.
Okay, perfect. Any other questions? What if you get slow payers or bad debts?
Slow payers, if it goes past the 120 days, typically that invoice will fall off the funding regime. So if you've had a £1,000 invoice and you've had 80% against it, when it goes past 180 days, that £1,000 invoice drops off, and that £800 effectively will come out of your availability, so that gets knocked off. Bad debts, equally, if it's a recourse facility, that comes back to you. The bank's not covering that unless you've got credit insurance, in which case the credit insurance should pick up the bulk of it.
Perfect, thank you. Another question. Other than growth, when should businesses consider invoice financing?
Invoice financing can be a great tool. If you've got a very stable business and you all grow in business, invoice finance can be a great way to get cash out for various projects. For example, I'm doing a project at the moment to buy a business. The management team have got no cash to put into it. The biggest asset is the ledger. The vendor, the person selling the company, has agreed to take some of the money over a period of time, and we've actually managed to raise all the cash they need to find on day one by putting in an invoice finance facility. Now, we spend a lot of time with that one, making sure that the future cash flows look solid and that taking all the cash out on day one by using an invoice finance facility wasn't going to create a problem further down the line. In that situation, it works. So we've used it to fund the actual acquisition of the business.
Perfect. Okay, I think one last question. How do you ever get out of an invoice finance facility?
Okay. There are two questions that very often come up, or two statements that come up from clients time and time again. Invoice finance is a last resort, and once you're in, you can never get out. Invoice finance is no longer seen as a lender of last resort. Banks are looking more and more towards invoice finance to provide working capital facilities, so it has become a very much more mainstream facility. How do you ever get out of it? Well, actually, it is a bit more difficult because you're accelerating your cash flow. You're having the cash now that you wouldn't normally have got till 3 months' time. So to get out of an invoice finance facility, you have to be disciplined and work the facility down over a period the same way as you would if you wanted to get out of an overdraft facility. You have to let the cash build up in your bank account so that you can not draw on the invoice finance facility and still have enough cash to move forward. Actually, most businesses find once they use an invoice finance and it's working for them, they don't particularly have any great desire to get out of them because it gives them the cash to grow the business or to make acquisitions and do other things.
Thank you. Perfect. I'm sure Ian's put his mobile number on the slide here, so I'm sure if you have any other questions, you can contact him and he'll be happy to talk
Absolutely.
to you. I will this afternoon be sending out a copy of Ian's presentation to everybody, so thank you so much for joining us. Sorry about our technical blip at the beginning. If you'd like me to email me if you'd like me to send you a full recording of today's webinar, and I can do that also with the slides. Okay, many thanks again and hope to see you same time next week.